I have a Spotify subscription. I don't know if you have one, but it's the music streaming service most people use. So let's look at the numbers. Is it a buy or is it not? Well, overall we can see there's still growing subscribers at a fast pace. 23% in total, 15% when it comes to premium subscriptions, and in return, revenue is of course also growing. Now of course, premium is where they have the most margins, around 29.1%. Ad supported, obviously less of a margin, but this is something that is interesting about Spotify. When you look at tech companies, usually the margins, at least the gross margins, are fairly high because setting some bytes and sending them over the internet usually doesn't cost anything. They have to pay for the product. They don't own the music. And as we can see from the premium margins, they usually have to give around 70% of the money they get to the music labels. The people most people listen to all the time, they are signed with labels. And those labels have a lot of negotiating power. This is why Spotify has to give a lot of their margin to these producers. And this is what leads to Spotify's famous unprofitability. Well, yes, their gross profit has been increasing all the time. Their earnings per share has not. In fact, no matter how much the business scale, the earnings per share hasn't grown. Spotify is a business that cannot be more profitable with scale, at least not in big parts. Let's say you sell a subscription for your Excel sheet. You make Excel sheets, they're super good, people get a subscription for them. Well, making the Excel sheet maybe costs you a bit, you make it, you sell it, after 10,000 users, you're profitable. And every money you get after the break-even point is just pure profit. Well, not for Spotify. No matter how much they grow, they will always only get 30% of the money that you pay them. Doesn't matter if they have 1 million users, doesn't matter if they have 1 billion users, doesn't matter if they have 1 user. They will always pay 70% to the music artists. But then they need to manage their entire company with 30% of the money. And while that might be possible, it is very hard to do that profitable. We can see the operating expenses are quite high, 1 billion per quarter. And when you don't even make 1 billion in gross profit, obviously that's gonna lead to negative operating income. Yes, operating cash flow will be different just because there's a bunch of accounting that's going into that, but overall the company is just simply not profitable. And that's why they're trying to focus away also from music. They're really focusing on, for example, podcasts. Why? Well, because here they don't have giant labels that force them to give up 70% of the money. Here, if they have like an exclusive podcast, they can make an individual deal. Or if someone just makes a podcast on there, they don't have to give up that much money. And that explains why they spend these huge amounts of money on these exclusivity podcasts, like with Joe Rogan, which is, by the way, not even Spotify exclusive anymore. We can see this over the gross margin. It has basically not improved. It has been constantly around 25%. If they would be able to divert from music away and go into other stuff like podcasts, then yes, maybe they would be able to go into profitability. But I do not see why Spotify would win in the podcast segment. And that's another reason why I don't think Spotify is a good investment. There's just no difference between Spotify, Apple Music, Amazon Music, YouTube Music. Yes, they all maybe have a different UI. Some people think one of them is better when it comes to the UI. But they all usually have around the same music. And when it comes to podcasts, yes, maybe you can have some exclusive podcasts where people are like, oh, I really like this podcast. I'm gonna go listen to that on this website or this app. But overall, most people will just use their preferred UI, their preferred app. Maybe I already use YouTube a lot, so I'm gonna use YouTube Music. I'm already an Apple fan, so I'm gonna use Apple Music. Spotify is just nothing that differentiates it. And Spotify reminds me a lot of Netflix in the beginning. Netflix in the beginning also had the issues with having to give a lot of their money away to the producing studios like Disney. Only when they started to bring out their own movies and change the deals around them, then gross margins improved greatly. Because Netflix before couldn't scale as well. They had to give a set amount of money away. But then they started producing their own movies, they started getting better deals because of their size. But with Spotify, that is just not the case. They can't do the same thing. Netflix movies will only be on Netflix. But with Spotify, there is no exclusivity in music really. So can Spotify achieve that is the question. Can they have enough original podcasts to make it worth it? Or can they get enough of exclusive music? Can they get better deals on the music? Can they maybe cut the pay on those? That is a gamble. I gotta give one good thing to Spotify though. Their share-based compensation has been cut a lot. It's now only 321 million. Only. That's currently less than they make in free cash flow, but this is a one-off free cash flow spike. And we can see they have been at around 5% free cash flow margin for a long time. Let's say they're gonna have a 10% margin. A 10% free cash flow margin. Let's phrase it like this. That is a doubling of the margins. That would give them $1.3 billion in free cash flow. That's a very high multiple on a 45 billion market cap. And that is if they would be able to achieve that high margin which they have never achieved really. Yes, the company has a lot of money, $2.5 billion currently on the books, but overall I'm just not hopeful when I look at the Spotify business. But let's run the numbers. Let's say they get the 10% in free cash flow. That will be around $7 per share. That ignores stock-based compensation. Let's say they cut out stock-based compensation completely. Every employee is paid in cash, and they still get a 10% free cash flow margin. Which is, by the way, giving them a casual $300 million. Just for free. You know, we just want to have a calculation. Just want to think optimistic here. Well, let's say they grow revenue at 18% for the next 5 years. Faster than they are right now, and 15% afterwards. So basically, just a teeny tiny slowdown in revenue growth. Plus, they get a 20 multiple. Well then, intrinsic value of $215 per share. Still below the current value. And this is if everything goes perfect for the company. Eliminating stock-based compensation. 10% margin. Uninterrupted growth for the next 10 years. No down year. Only up and up and up. And a 20 multiple. And even then, they're not worth the current price. Well, what if it goes even better? Higher growth and a 30 multiple. Well then, yeah, then you make money. But that is depending on a 30 multiple. And that everything goes well. So, no. Well, what if stuff goes normal? Or rather, not even that good? They still get a 10% margin, and they only grow for 10% for the next 5 years, and 8% afterwards, and only get an 18 multiple. Well then, $106 a share, it's worth $240. You make a 1% return in this case. So, I think it's better just to park your money in the bank. I think even though there you make more. So overall, Spotify is not a company that I'm interested in. I know a lot of people like it. I personally use it. It's a fantastic service, but it has a lot of competition. It doesn't have a lot of unique points. Its business model is not that great. Sure, it can grow via podcast, but that's just a theory. It is not clear if they will achieve that and where their unique selling point will be there. So, well, I'm passing on this. I'm not putting it on my watch list. What do you think? Write in below. Have a good day.